Welcome to the Research Desk.
Glad to be here for this one.
So in 2020, a multi-billion-dollar, globally systemic financial institution issued a formal public apology. And this apology was for activities that were originally facilitated by, well, conversations and notes written on napkins in a late 17th-century London coffee shop.
Which is just wild to think about when you frame it that way.
Right? I mean, how does a room full of people drinking coffee become the absolute financial bedrock of global maritime trade? Think about that for a second. The institution we're talking about is Lloyds of London.
The iconic Lloyds.
Exactly. They built the ultimate place where maritime facts arrived first. They translated scattered, totally chaotic shipping gossip into priced risk, and ultimately, massive capital allocation.
But they also learned a brutal lesson along the way. Even the absolute best, most sophisticated risk market cannot price a future that it has no signal for.
Which brings us to the core tension today. My position is that Lloyds of London represents the ultimate triumph of the marketplace model. It's a revolutionary intelligence condenser that proves gathering the right information in one single room can actually price the unpriceable.
And I come at it from a different way. My stance is that Lloyd's actually exposes the fatal flaw of all information platforms. They create this incredibly dangerous illusion of omniscience. They successfully price the visible risks, sure, but while doing that, they blindly concentrate exposure to invisible systemic catastrophes.
To truly understand the magnitude of what Edward Lloyd achieved, we really have to look past the modern corporate facade of what we call insurance. When I look at the historical trajectory of Lloyd's, I do not see a normal insurance company.
What do you see instead?
I see a marketplace machine. The absolute genius of Edward Lloyd was realizing that information is the product before insurance is the product. The true edge that Lloyd's possessed was not some vault of closely guarded proprietary secrets, which is, what modern corporations rely on today.
Right, they didn't have algorithms or black boxes.
Exactly. Their edge was the gathering process itself. By bringing together sea captains, wealthy merchants, and risk-taking underwriters into one single rhythmic environment, Lloyd solved one of capitalism's deepest problems.
How to fund massive, incredibly dangerous opportunities without ruining single balance sheets.
Yes. Because when things go wrong at sea, they go catastrophically wrong. The creation of Lloyd's List in 1734 is the ultimate proof of this concept. It proved that concentrating intelligence naturally attracts capital. You build the gravity well of information, and the money just inevitably follows.
That is a very compelling argument. But creating a centralized hub for data in the 1600s, while monumental, was also structurally a trap. The marketplace machine you were describing was designed entirely for the physical, immediate world.
You mean the literal ships and cargo?
Precisely. It was built to process the reality of a sunken ship, or a pirate attack off a known coast, or, a familiar storm route. The market confused concentrated information with omniscience.
I think omniscience is a strong word, but I see where you're heading.
Well, look at what happened when they faced long-tail liabilities, most notably the asbestos crisis that hit the market with absolutely devastating force in the late 20th century. The very mechanisms that made Lloyd's powerful, the syndicates, the internal reinsurance networks, and especially those private investors with unlimited liability, they became a doom loop.
It was definitely a severe crisis, yes.
It almost destroyed the entire institution. So the real lesson of Lloyd's is not just a celebration of marketplace capitalism. It is a stark warning for every modern platform. You cannot price a future that hasn't learned to speak yet.
Let us ground this in the reality of 17th-century maritime risk. London was rapidly ascending as a global maritime city. The River Thames was just choked with ships carrying sugar, tobacco, wool, wine, timber, spices, bullion.
And we absolutely have to acknowledge the grim historical reality that prompted their 2020 apology.
Yes, crucially, these vessels were also carrying enslaved human beings. This highlights the intense moral and physical complexities of the risks being insured in that room. Human lives, national economies, and imperial ambitions were essentially floating on wooden boards across highly hostile oceans.
Hostile is an understatement. The risks were omnipresent and incredibly immediate.
Right. War with European rivals, like the Dutch or the French, could break out while a ship was mid-voyage. Colonial expansion bred privateering. Piracy was just rampant.
Not to mention the natural elements. Storms, fires, outbreaks of disease like scurvy or dysentery.
Exactly. Add in poor navigation tools and uncertain credit, and every single voyage was a complex bundle of potentially ruinous variables. A cargo that looked incredibly profitable when it was modeled in a counting house in London could simply vanish in the Atlantic.
And the merchants understood this danger perfectly well. They weren't naive to the risks of the ocean.
No, they weren't. The blind spot was not ignorance of the ocean's wrath. The blind spot was that risk information was entirely scattered.
It was fragmented in a way that is, quite honestly, difficult for a modern observer to fully comprehend. We are talking about an era with no telegraphs, no standardized reporting, and certainly no real-time data feeds.
Right. Knowledge was completely siloed.
Siloed in the minds of individuals who really had no formal mechanism to combine what they knew.
Let me paint a picture of that fragmentation. One captain knows a specific harbor has silted up, making it extremely dangerous for deep draft vessels. Meanwhile, another captain had just spotted pirate ships lurking near a common trade route.
And neither of them are talking to each other.
Exactly. Or a broker sitting in a tavern hears a rumor that a particular ship is weeks overdue. A merchant knows another merchant has overinsured his cargo, which creates a severe moral hazard. A ship owner knows the subtle difference between a highly disciplined captain and a reckless one who drinks too much at sea.
All of this knowledge exists physically in the city.
It exists, but none of this information automatically became a market price. It lived in isolated conversations and handwritten letters that took weeks to cross the continent, in dockside taverns and in private ledgers.
And insurance fundamentally turns uncertainty into a price.
Exactly. But before uncertainty can be priced, the market has to agree on what it actually knows. None of this scattered intelligence could forge a disciplined premium until it had a meeting point.
Which brings us to 1688.
Yes. The first recorded mention of Lloyd's Coffee House appears in the London Gazette in 1688. It was initially on Tower Street, but then it made a crucial move to Lombard Street in 1691.
Moving right into the city's mercantile core.
Placing it perfectly. And Edward Lloyd, he was not just a barista ahead of his time, he was an infrastructure architect.
Explain that architecture to me. What specifically did he do that transformed a simple coffee house into an infrastructure layer?
He actively supplied the tools of formalization. He didn't just serve drinks. He provided pens, ink, paper, large tables, and a highly structured environment for business.
So he was providing the hardware, essentially?
Absolute latest news from arriving ships, the moment they dropped anchor. He even established correspondence in ports across Europe to send information back to him.
That is a massive operational effort for a coffee shop.
It was. He realized that if you provide the environment where the facts arrive first, the people who desperately need to trade on those facts will spend their entire day in your establishment. In a world long before electronic feeds, a room full of the right people, equipped with the tools to record and formalize their agreements, was the ultimate coordination layer.
It's an early search engine.
Exactly. It is the direct 17th-century equivalent of a highly curated search engine. It aggregated the fragmented data of the world and made it searchable simply by walking into the room and listening.
That's a compelling argument. But have you considered the actual nature of the transactions happening over those pens and paper? Drawing a straight line from men drinking coffee to a highly disciplined financial market really ignores a vast amount of chaos.
There was certainly volatility, but it formalized quickly.
I'm not so sure. Early marine insurance easily, and I mean frequently, shaded into reckless gambling. People in these coffee houses would write speculative policies on almost anything.
They did have a broad definition of risk at the time.
Broad is one way to put it. They would bet on the life expectancy of public figures. They'd bet on whether a besieged city would fall in a war, or on the outcomes of high-profile trials. A room full of gossip does not naturally create disciplined pricing. Unregulated gossip often just creates speculative manias.
But marine insurance was the core product, and that required real discipline.
True, but the real innovation wasn't just the room itself. It was the formalization of the two-sided market, specifically the invention of literal underwriting.
Which is a brilliant mechanism.
It is, but we use the word underwriting today as a sterile corporate term. We have to look at its physical origin. Wealthy men would literally sign their names under the policy terms written on a piece of paper, indicating the specific percentage of the risk they were willing to take on personally.
This slicing of risk is the absolute core mechanic of capitalism here, taking a massive exposure like the total loss of a fully loaded merchant galleon and breaking it down into manageable fractions for dozens of individuals. That is what lured the capital in.
Because no one could take the whole risk.
Right, no single individual could absorb the loss of a ship, but 50 men taking a 2% slice each. Suddenly, the impossible voyage is funded.
But we have to look very clearly at the vulnerability this created. It established a framework of delegating massive, unlimited risk to private individuals based entirely on the supposed intelligence of the room.
Unlimited liability was the standard of the era.
But think about the scale. They built a system where a single individual could pledge their entire personal fortune based on the conversational consensus of a coffeehouse.
I see why you emphasize the danger there. Handing over your personal fortune based on tavern gossip sounds reckless, but the market did not stay a chaotic gambling den. It evolved a highly sophisticated machine to manage that exact vulnerability.
Okay, let's break down this machine.
That machine relies on 6 distinct gears that lock perfectly together to process scattered information into stable capital allocation. We really need to deconstruct this engine. The first gear is the room itself.
The physical environment.
Yes. Face-to-face trading survived for centuries because specialty insurance deals with anomalies. It depends heavily on judgment, trust, and the speed of reaction to a nuance in a broker's voice. Complex risk fiercely resists pure automation. You literally need to look the underwriter in the eye when you present a uniquely dangerous voyage.
I understand the romance of the physical room, but let us clarify the specific roles. What does the broker actually do in this setting?
The broker is the second gear, and they are definitely not just salespeople. They are information translators.
Translators? Give me an example.
Okay, a merchant approaches a broker with a risk. Let's say a complex shipment of timber moving through a politically unstable region. The broker takes the raw, messy reality of that risk and packages it into a standardized submission.
So they clean up the data.
Exactly. But more importantly, the broker possesses the vital meta-knowledge of the room. They know exactly which underwriters have the appetite, the historical data, and the expertise for that specific exposure. They take this packaged risk and walk up to the third gear, which is the underwriter.
And these underwriters are the true specialists.
They are. They possess the highly localized intelligence of the market. They evaluate the broker's submission, they apply specific exclusions, and ultimately they determine the price.
This is where the structure becomes extremely precarious in my view. The underwriter is making the final call, setting the price, and accepting the risk. But they are not actually using their own money.
That brings us to the fourth gear, the syndicates. A syndicate is the capital vehicle. Think of it like a modern venture capital fund. It is an annual venture managed by a managing agent, pooling the capacity to accept these massive insurance risks.
And who is funding these syndicates?
Backing those syndicates is the fifth gear, the members. Historically known as the names, these were the private investors, the wealthy individuals supplying the actual capital that underpin the entire structure.
The people taking all the actual financial risk?
Yes, and finally, we have the sixth gear, which is the governance layer, the chain of security.
Which was supposed to prevent disasters.
It did prevent many. This includes premium trust funds, where the premiums are held safely to pay future claims, and crucially, the central fund. The central fund is a mutualized pool of last resort. It's designed to safeguard the policyholder if a specific member or a specific syndicate completely fails.
So 6 gears locking together.
Yes, and when you put these 6 gears together, you get a loop that constantly compounds. Every outcome, every safe arrival, every sunken ship, every court dispute feeds directly back into the market's memory.
And Lloyd's List was the ledger for that memory.
Exactly. The physical manifestation of this memory was Lloyd's List, which started in 1734 and actually became a daily publication by 1837. It was the daily operating system update for the entire market.
It was incredibly efficient for its time, I'll grant you that.
Does this not represent the perfect capitalist engine? It does not need to own the ships. It doesn't need to own the shipyards. It just needs to own the venue where the facts arrive first.
I'm sorry, but I just don't buy that it is a perfect engine. If we look closely at Gear 5, the names, we see an architecture that is bordering on financial madness.
Madness is a strong word for a system that functioned for centuries.
But look at the mechanism. Private individuals were supplying capital with unlimited liability. Let that sink in. Unlimited liability.
It was the standard way of doing business before the widespread adoption of the limited liability corporation.
But the leverage involved is terrifying. Imagine a wealthy doctor in, say, the 1970s. You provide proof of wealth to become a name at Lloyd's. You delegate your capital to an agent. That agent places you on various syndicates.
Right. Spreading your capital across different risks.
Spreading it, sure. But the underwriter for that syndicate, whom you, as a doctor, may never have even met, makes a judgment call on a highly complex industrial risk. If that underwriter is wrong and the losses wildly exceed your premium income, you do not just lose your initial investment.
You are liable for the full extent of the loss.
You are legally obligated to pay until you have absolutely nothing left. They could take your country estate, your primary home, your savings. You are on the hook down to your last cufflink.
It required immense trust in the underwriting expertise, yes.
This structure creates extraordinary, almost incomprehensible leverage to expert judgment. When the machine works and the risks are visible and well-priced, it prints money. But when that expert judgment is blind,
Then the losses are catastrophic.
it creates uncontainable ruin for private individuals. And that is exactly what happened when the machine hit the wall in the late 20th century.
You are referring, of course, to the massive shift from marine risk to long-tail liability in the 1980s and 90s.
I am. This is where the signal completely disappears and that illusion of omniscience shatters into pieces. Contrast a traditional marine risk with what actually hit Lloyd's during the asbestos crisis.
Marine risks are immediate.
Exactly. A sunken ship is a visible, localized loss. The ship leaves port, a storm hits, it goes down. The loss is finite, it is localized in time, and the claim follows very shortly after the event. The market processes that beautifully.
But asbestos was different.
Completely different. These were not events, they were industrial time bombs. A syndicate might have written a general liability policy for a massive American manufacturing company in, say, 1960.
And the premium is collected, the year closes.
Right. The underwriting year closes, everyone pats themselves on the back, they think they made a tidy profit, and the names take their dividends. But asbestos does not sink a ship immediately. It sits silently in the lungs of shipyard workers, construction workers, and mechanics for decades.
The latency period is the killer variable here.
Yes. The policy written in 1960 might not produce a mass wave of claims until 1990. This completely, fundamentally broke the information machine. It failed on multiple fronts simultaneously.
Because the market memory couldn't price a 30-year delay?
First, it completely underpriced latency, that massive time delay between the exposure to the fiber and the actual manifestation of the disease. Second, it drastically underpriced legal evolution. U.S. courts in the 1970s and 80s fundamentally changed the meaning of liability.
Explain exactly how the courts changed it. The market had been dealing with legal disputes and complex jurisdictions for centuries. Why was this specific legal evolution uniquely destructive?
Because they expanded the scope of coverage retroactively. Courts began interpreting older, vaguely written general liability policies in ways the original underwriters never, ever intended.
They allowed claims to stack?
Exactly. They allowed claims for incremental exposure over multiple years, triggering multiple different insurance policies for a single claimant. An underwriter sitting in a room in London in 1960 had no signal, no data point, no gossip in the underwriting room that could have possibly predicted how a federal judge in 1985 would
would interpret a policy exclusion regarding airborne particulates.
So the information condenser failed because the information didn't exist yet?
Yes. The data-rich room did not know enough because the information it needed did not exist in a form the market could process. It was hidden in microscopic fibers and in the future decisions of judges who, frankly, had not even been appointed to the bench yet.
It is absolutely true that the latency period challenged the foundational premise of an annual accounting cycle. The market was accustomed to risks that resolve themselves quickly. When a risk takes 30 years to manifest, the entire concept of closing an underwriting year and distributing profits becomes a dangerous fiction.
It didn't just challenge it, though. It weaponized it through what became known as the reinsurance doom loop.
The LMX spiral.
Yes. This is the most damning failure of the marketplace design, because Lloyd's was a market and not a single unified corporate balance sheet. Syndicates routinely reinsured each other. Let us walk through the mechanics of the spiral because it's terrifying.
Walk me through it.
Okay. Syndicate A writes a highly dangerous U.S. liability risk. To protect its names from catastrophic loss, Syndicate A goes and buys reinsurance from Syndicate B.
Which makes sense. They are laying off some of the exposure.
It makes sense in theory, but Syndicate B, now holding a newly concentrated risk, buys what is called retrocessional reinsurance from Syndicate C.
Retrocessional reinsurance is simply insurance for insurance companies.
Correct. They thought they were distributing and spreading the risk safely throughout the market, but they were actually just circulating it in a closed loop.
Let me make sure we are dissecting this correctly for the listener. You are describing the London market excess of loss spiral, the LMX spiral. Because all these syndicates were operating in the exact same room, looking at the same brokers, they were essentially passing the same toxic parcel of risk back and forth.
Precisely. Syndicate C might unknowingly buy retrocessional reinsurance back from Syndicate A. They were actively concentrating the correlation without realizing it.
So when the claims actually hit?
When the massive wave of asbestos and pollution claims hit in the late 1980s, this internal web acted like a transmission vector for a financial virus. The losses literally bounced back and forth between syndicates. Every single time a claim triggered a reinsurance contract, it created a new liability for another syndicate, compounding the administrative costs and the total exposure with every single hop.
It created artificial volume and hid the true aggregated risk.
It threatened the solvency of the entire institution, and we really cannot gloss over the human toll here. We are talking about names, real people facing total financial annihilation.
The suicide rate among names during this period was tragically notable.
Thousands of individuals were completely ruined because an elegant information market allowed infinite leverage to be applied against risks it fundamentally could not see.
I see why you emphasize the devastation of that period. The human cost was undeniably severe and deeply tragic. But let me give you a different perspective on what that crisis actually proved.
I'm curious how you can view that as a positive.
You look at the asbestos crisis and see the fundamental failure of the marketplace model. I look at it and see the ultimate proof of the architecture's resilience.
Resilience? They almost went bankrupt.
Yes, the machine hit a wall. It encountered a risk profile that its historical data was entirely unequipped to price. But look at what the institution did. It did not collapse and vanish into history. It adapted.
With a massive, painful intervention.
The crisis forced the 1996 Reconstruction and Renewal Settlement. This was arguably one of the most complex financial restructurings in modern history. The market recognized that to survive, it had to surgically amputate the contaminated past from the viable future. So they created a vehicle called Equitas.
Explain the actual mechanics of Equitas, because how exactly do you amputate decades of toxic liability?
Equitas was a massive, specially reserved runoff reinsurance vehicle. The market took all of the 1992 and prior non-life liabilities, all the asbestos claims, all the environmental pollution, all the latent industrial time bombs.
And they bundle them together.
Yes, and reinsured them all into this single heavily capitalized firewall entity. Equitas essentially absorbed the toxic past, allowing the rest of the market to move forward with a clean slate.
I'm sorry, but I just don't buy that this was a clean, elegant solution. It was a massive, desperate bailout funded by forcing the existing names to pay exorbitant settlement credits. The market trapped its own investors and squeezed them to fund its survival.
It was definitely a painful mutualization of loss. The names had to contribute to fund Equitas, yes, but Equitas allowed the market to ring-fence its past mistakes. It provided the leaving names a path to finality, legally halting the endless, terrifying capital calls that were destroying their lives.
It stopped the bleeding, but at a huge cost.
But more importantly, it allowed the living market to fundamentally reform its capital rules. Following reconstruction and renewal, Lloyds phased out its reliance on unlimited liability names and moved toward modern, limited corporate liability structures.
So they abandoned the very thing that funded their growth.
They improved it. They improved its centralized oversight and established much stricter risk controls to prevent another LMX spiral. The institution itself proved more valuable than the old assumptions it abandoned.
The brand survived, yes.
The fundamental premise survived. The idea that the world needs a centralized venue to debate and price complex risks survived. The fact that Lloyds exists today, stronger and more heavily capitalized than ever, proves that a marketplace machine, if it's properly governed, can survive even a complete failure of its own predictive models.
Surviving a self-inflicted near-death experience is not exactly a ringing endorsement of the platform's omniscience. It just proves that if you have enough trapped capital, you can eventually build a firewall. The underlying vulnerability of the platform model remains.
It proves that the architectural pattern holds, and that pattern is vital for understanding modern capitalism. If we zoom out and look at the deep history of financial architecture, we see distinct eras of how capital interacts with information.
Let's trace that history then.
Consider the Medici Bank in the Renaissance. Their defining edge was internal visibility. They pioneered double-entry bookkeeping, maintaining branches across Europe with strict ledgers and meticulous correspondence.
Right, they built a closed information network.
Exactly. They built a machine that allowed the central bank in Florence to see its own internal network clearly. Then look at the Dutch East India Company, the VOC. Their edge was a massive corporate memory machine.
They internalized the physical assets.
Yeah, and they owned their own ships. They internalized the highly dangerous physical voyages into a single corporate structure. But Lloyd's gives us a completely different blueprint.
The marketplace blueprint.
Yes. The Lloyd's pattern is not about owning the data internally. It is not about owning the physical assets. The pattern is simply to own the place where data becomes decision.
Which brings us to the modern era. You are arguing that this 17th-century coffeehouse model is the direct template for modern technology platforms.
I am, absolutely. The Lloyd's blueprint is the most modern of all historical market structures. Look at the apex institutions of our current economy. They are all, at their core, information condensers operating on the exact same logic as Edward Lloyd's coffeehouse.
Such as?
Take Bloomberg. A Bloomberg terminal does not issue bonds. It does not mint currencies. It does not drill for commodities in the North Sea. It simply concentrates all the disparate market information into one highly structured interface, placed exactly where the decision makers sit.
It's the modern coffeehouse table.
Exactly. Or look at financial exchanges like the New York Stock Exchange or NASDAQ. They do not own the underlying corporate assets. They own the venue, the matching engine, the clearing logic, and the trust layer.
They process the transactions of others.
Visa and MasterCard do not hold the consumer deposits. They define the rules, the routing, and the global acceptance network. Cloud computing marketplaces like AWS operate on this exact same principle.
AWS is an interesting comparison.
They aggregate computing demand, they handle the billing, and they provide a trusted distribution channel without building every single piece of software that runs on their servers. They all run on the Lloyd's flywheel.
Concentrate participants, standardize the flow of information.
Make transactions repeatable, let capital price the exposure, and use the sheer volume of activity to improve the platform's memory. Capitalism does not require proprietary, siloed information to be powerful. Relational information,
Building the right room with the right rules can price the world's most complex realities.
That is a fascinating historical through line, I will admit. But I have to bring the hammer down on the modern parallel you are drawing. Because if every modern platform runs on the Lloyd's blueprint, then every single one of these platforms has a Lloyd's problem. And that is a terrifying prospect.
You think they're headed for their own asbestos crisis?
Absolutely. Marketplaces, whether they are selling marine insurance in 1700 or processing cloud computing demand today, have a deeply ingrained, almost unavoidable tendency to confuse volume with understanding.
Because they see so much activity, they assume they understand the risk of that activity.
Exactly. Because an observability platform processes 1 million transactions a second, it believes it deeply understands the underlying risk of those transactions. It mistakes its vast repository of historical loss data for an accurate map of future truth.
You believe modern digital platforms are blind to their own systemic risks in the exact same way those syndicates were blind to asbestos.
I know they are because the incentive structures demand it. Think about the modern equivalents of those 6 gears you laid out. When a modern risk analytics platform, or a massive cloud marketplace, or a decentralized finance exchange splits risk or aggregates demand, are they actually seeing the whole picture?
They have more data than Lloyds ever did.
More data, yes. But are they seeing the hidden variables, or are they just letting incentives drift? The modern broker wants placement fees. The platform wants daily active users and transaction volume. The capital just blindly wants yield.
Frictionless trading.
Yes, they engineer these beautiful, frictionless interfaces that make it incredibly easy to take on exposure. But friction is often what forces human judgment to pause and evaluate. When you remove friction entirely, you vastly accelerate correlation.
Explain how that correlation manifests in a modern cloud environment. How does the asbestos crisis map onto a software platform?
Look at the shared responsibility model in cloud computing. A company builds its entire infrastructure on AWS. They use hundreds of third-party open-source libraries. The cloud provider secures the physical facility and the hypervisor, but the customer is fully responsible for the code running on top.
Right, that's the standard model.
But deep inside that code is a vulnerability, something like the Log4j flaw a few years ago. That vulnerability sits there for years, completely invisible to the pricing mechanisms, completely invisible to the security dashboards, just like asbestos fibers sitting silently in a worker's lung.
It's latent risk.
Exactly. The platform is aggregating millions of users, creating immense operational efficiency, but it is simultaneously concentrating systemic exposure to that single hidden variable. When the vulnerability is finally discovered and exploited, the shock cascades through the entire network instantaneously.
The digital equivalent of the LMX spiral.
It is the reinsurance doom loop running on fiber optics. The ultimate danger for any elegant platform is the moment it discovers that instead of concentrating intelligence, it has actually just been efficiently concentrating ignorance. It has built a highly efficient machine for distributing a fatal flaw.
That's an interesting point, though I would frame it differently. The risk of concentrating ignorance is definitely real, which is exactly why the governance layer is so critical. The modern equivalent of the central fund and the franchise board at Lloyds is what separates a truly resilient market from a fragile network.
But governance is always reactive.
A platform without governance is just a crowd. A platform with robust governance, strict capital requirements, standardized transparency, and forced stress testing becomes a resilient market. The digital economy is currently building those exact governance layers.
Governance is always backward-looking. Governance is always perfectly designed to prevent the last crisis. The regulations that govern modern markets are exactly like the Equitas firewall. They are built after the damage is already done, to clean up the monumental mess of the previous era's blind spot.
They adapt and improve over time.
But let us not forget the core of the asbestos lesson. The data-rich room did not know enough. And it did not know enough because the information it needed did not exist yet.
That is the nature of the future.
Right. But a risk analytics platform today might be perfectly pricing the historical volatility of a global supply chain. But can it price the geopolitical reality of a naval blockade happening 3 years from now? Can a decentralized autonomous organization perfectly price the risk of an undiscovered cryptographic flaw in its own smart contract code?
It cannot.
I'm not convinced by that line of reasoning because you are demanding absolute omniscience from a system that is fundamentally designed for adaptation. The marketplace machine does not claim to predict the future perfectly.
It certainly acts like it does when it prices the risk.
It claims to be the most efficient mechanism for pricing the future based on the best available current signal. And crucially, the fastest mechanism for adjusting that price when a new signal actually arrives. Capitalism does not need perfect foresight. It needs a mechanism for recovery and recalibration.
Recalibration is a very sterile word for bankruptcy, ruin, and massive systemic bailouts. The wall is still there. The boundary of the information edge has not moved just because our computers are faster than Edward Lloyd's quills.
Faster processing means faster adaptation.
But information markets are undeniably powerful only when the relevant signals are close to the transaction. They excel at pricing the immediate, visible, physical world. But they are incredibly systemically fragile when the decisive facts are hidden in time. Future science, future social values, future climate patterns, these things simply cannot be priced by looking at a dashboard of historical data.
To synthesize our discussion today, I remain very firm in my assessment. The evolution from a smoky, crowded coffee house on Lombard Street to a multi-billion-dollar global risk market proves that the architecture of the gathering place is absolutely paramount.
It's an incredible story of growth, I won't deny that.
Capitalism does not require proprietary, siloed information to be powerful. Relational information building the right room, establishing the right rules, and aggressively protecting the integrity of the capital can price the world's most complex risks. The Lloyd's blueprint is the foundation of the modern digital economy because it solves the fundamental problem of how to trust strangers with massive amounts of capital.
And I maintain that while the blueprint is undeniably successful at generating huge transaction volume, it carries a fatal, irreducible flaw. The concept of the wall is inescapable. Historical data is never enough.
But it's all we have to start with.
True. But the most dangerous risks, the systemic shocks that threaten to bring down whole economies or digital infrastructures, are always the ones that do not look like risks inside the current reporting system. They are the risks that simply have not learned how to speak it.
It is a profound tension. We look at the platforms we all rely on today, the financial exchanges, the massive data aggregators, the cloud infrastructures. The central lingering question we must leave you with is this: are these modern platforms truly concentrating intelligence, or are they merely efficiently concentrating exposure to the next great unseen risk?
A question we will likely find the answer to the hard way.
There is undoubtedly much more to explore in the historical architecture of markets and how the past continues to blueprint our digital future. This is the Research Desk, officially signing off.